What's up, YouTube? It's Todd Horst here with Tasty Tracker. It's the end of the year, and so I've been thinking about the different traits a trader has. And so I wanted to do a quick video to sort of document the traits that I find valuable. I tried to make them a little bit unique. Hopefully, they're applicable and can help you out. And then we can all have a better 2021. So first of all, I think it's worth studying the traits and mannerisms of successful traders. You know, it's always good to take advice from somebody who's more successful than you are. I personally believe that everybody has something that they can offer, or maybe it's not just a piece of advice that somebody gives you, but it's their advice that they give you, which then triggers another thought or mode of thinking or additional perspective, etc. So even if somebody isn't as successful as you are, they definitely still offer a lot of value, and so I think it's worth studying and thinking about what makes other people successful. As I said, I tried to be a little bit unique with this list so that it's not the same old that you've seen 100 times. But the overarching goal here is to be in tune with yourself and your strategy, your emotions, so that you can be successful and, more importantly, sleep at night. I know, you know, a lot of people starting out start with gambling and they end up losing it all, or even if they don't, they have a lot of they go from position to position that is extremely risky, and then they have trouble sleeping because their position size is too large, etc. So again, some overarching themes is that you cannot control the market, but you can control yourself. So what can we do to maximize our efficiency here and really, like I said, stay in tune with yourself? Um, so I want to work on my weaknesses and leverage my strengths. Obviously, that's what we all want to do, where we can sort of increase the base level that we're operating at. Um, and once you begin to be successful, and then it's just simply working on getting consistent at doing so. And then lastly, I think enjoying the fruits of labor. That looks like a lot of different things for a lot of people. Sometimes that's just withdrawing a, a consistent amount each month. Um, my dogs. Sometimes that's just withdrawing a consistent amount each month. For me, I like to chart it out and see the progress. That keeps me motivated to continue to work and learn. But the last bullet point here is that you don't have to be the best. You just have to keep going. So I think a lot of people, again, when they get into it, they start gambling, get into the stock market, that is. They start gambling, and you know, they're shooting for home runs, and really you have to be worried about blowing up your account, in my opinion, um, just so that you can stay in the game long enough to know what you're doing and be consistent. And you know, at any age you can increase your wealth. You know, I'm 35, so I still have a lot of time before I can retire. I still have a lot of time that I can build up as much of a account size as I can. So let's get into the first one, humility, which is a quality of being humble. So, you know, first of all, you don't know what events may happen. They could be political, environmental, economic, scientific discovery, social events, um, etc. There are a million possibilities of things that could happen each year. I've made several posts this year on Twitter about that just because something looks like it's the peak of the market in general doesn't mean anything. It can continue going up and up and up, way past what you could expect if there isn't a driver to have a pullback. Obviously, the big drivers recently, you know, were COVID, housing crisis, dot-com bubble. These things, they have a name because there was something that drove the markets down. Um, but but apart from those, the market generally goes up or goes sideways. It does just because it looks like it's at a top. Unless you have that driving factor, it's not going to go down. The point here is any of those events could occur at any time. They could occur back to back to back and continue to drive the markets down and down and down. Luckily, there's usually some space in between those things. Additionally, you don't know how the market will react to these events. There's a comment the other day that I saw about, I think it was some store closings, and the stock for that ticker went up. And people were questioning why that would happen. And it's the same as when there are layoffs. Generally, the market sees certain things as tightening the belt and as a good thing, whereas your um, default reaction is to say, "Oh, no, that's not a good thing that they're having to close stores." Uh, Third bullet point here is that you don't know what you don't know, um, which is the Dunning-Kruger here. I have the chart below where there's at first you know you don't know anything, and then very quickly you think you know everything. Um, but but then you quickly realize, or hopefully quickly realize, that you don't know everything, and oh my goodness, there's just so much to learn. I could never learn it all, and then that's where we start being productive here. Um, I think, back to the bullet point here of humility. I think a lot of people view that being humble as weakness or pathetic. I look at it the other way, where it shows strength and confidence. If you can acknowledge what you don't know, that makes you powerful because you know how to correct that issue. You can go out and learn those things that you don't know. But if you're too focused on something else or you're completely oblivious, then how can you correct something? So to me, being humble, I try to be humble. Um, Definitely, there are times when I'm not, when I'm, talking about programming or something else that I feel that I'm very experienced with. Um, but but overall, I try to remain humble and realize that even for what I do know, there is still so much more to know. So what am I focusing on here is controlling what I can control, gaining experience to help with your confidence. I think that's, the stereotypical newbie is asking everybody if their position is good or if they should close it and what percentage they should close it at and stuff. And that's fine to ask questions, but ultimately you are seeking out the experience, so that way you don't need to ask. You know what those answers are, and that's going to be different for everybody, obviously. Um, in order to uh, stay away from the Dunning-Kruger effect, or to get to that plateau of sustainability at the end here, obtaining any knowledge you can, but especially related to financial, um, expedites everything. Even if it doesn't seem related to the market per se, any financial knowledge increases your ability to execute. So I've had multiple financial classes over the years. I've done a lot of things. Like I said, I said before, I own rental properties, and that's a completely different area of finance. But having that broader base makes everything easier. Um, and then I think being present and in tune, in check, emotionally and intellectually aware, is just something that goes a long way to knowing where you're at on the Dunning-Kruger here, and being able to make sound decisions in the market. So, a thing I've said before again on Twitter is, if you're not feeling in tune with the market, it's better to sit on your hands than to put a position on. I'll do that many times where I feel in sync with the market, and you'll see me go heavy, and then other times you'll see me not put on anything at all. And there might be better opportunities on the latter half there, but if I'm not feeling in touch with the market, then I'm likely to put on positions on the wrong tickers at the wrong times, and miss those good opportunities because I'm not in the right frame of mind. So, and that can even be as simple as not getting enough sleep, or being stressed out, etc. So number two is being persistent, refusing to give up. I mean, this is an obvious one. If you want to achieve something, you have to treat it seriously. You know, a lot of people get in, they get excited, they want to learn everything they can. They try to cram all of this in, and there's a lot with options to learn, and then they sort of burn out. Um, and then simultaneously they blow up their account because they were too risky with their with the trades that they were doing. So you need to start off not needing the money. I was financially secure prior to starting, and you know, I'll do a video on this at a later date, but I've already talked about it in the past how you know, you want to start off with your IRA and your 401k, in my opinion, and paying down debt before you get into trading, because losing money, I mean, although I wish I would have uh, learned all of this stuff when I was 18, you know, I could only imagine where my account would be now. But the reality is, waiting until I was secure financially made it so that if I did lose all of my money, it wasn't a big deal. And thankfully, I have not blown up any accounts. But um, but if I had, it would not have disrupted my life in any meaningful way because I was financially secure prior to taking up trading. So don't start off needing money. And in fact, it should be the opposite. You should be okay losing all of that money. Obviously, that's not our goal. But if that does happen, we don't want to have it, like I said, risk not having a place to live or food to eat, etc. Another thing is everyone's strategy is different, and it takes time to develop that. So I definitely think you should take in all of the resources you can. There's a lot of videos on YouTube, a lot of people on Twitter, a lot of people on Discord, Reddit. All of these different places have people of all different experience and worldviews, etc. And that shapes their strategy. And you can start off by mimicking different people to see what styles feel right for you, and then you can slowly develop that into exactly your area that you enjoy. After you come up with the general strategy, you obviously won't always win. So, you know, to be persistent is to say, okay, I realize I got a loss. Maybe I got a string of losses, but I'm going to continue with the strategy that I know works, especially over time. Or maybe I need to tweak these couple variables in order to ensure that it continues to work going in the future if there's some very evident issues. Um, so I guess being persistent to me also makes me think about, you know, entering in on a down day where fear would tell you that that is the worst time. You know, oh my goodness, this stock could go through the floor and it's never going to come back up. Why would I enter in a bullish position? If you follow me at all, you know that I primarily do bullish positions, and that's true because we've been in a bullish trend for how many years. Even during COVID, I thought that was a short-term thing, and indeed we are back up over that. But um, in reality, going back to the bullet point here, entering in on a down day produces the best results, assuming you understand the nature of that move down. Is it a downward trend that's going to continue, or is the stock just taking a breather? You know, you have to be aware of all of the different factors going on. If you have a mindset that will tell you that you're going to do this for the rest of your life, I think it changes the way you approach things. You don't need to gamble to have this huge home run, but it's also just little things in the amount of time you invest can be spread out, I think, more, which is healthier, and you get to practice things as you're going along and test different theories out and really hone in on a strategy. Whereas if you are too focused on getting in and getting out, you know, you're going to overtrade, you're going to blow up, these types of things. Last bullet point on this slide is to be persistent about making money. That's what the persistence is, and growing yourself. And that's at the macro level. So I don't mean being persistent at the micro level about a specific thesis or a specific trade, a specific stock. You know, if you're very bullish on Tesla, that's great. But what happens when they have an extremely flat year? Which, what was it, 2018 or 19 was really flat for Tesla. It was just a bad year. So um, you could have deployed your money a lot of other places and made a lot more money than just sitting there because you are so bullish on Tesla. So, and that applies to individual trades. If a trade is not going well, you can try rolling it, doing something like that. But at the end of the day, you need to call it what it is. If it's a loser, it's better to just get out instead of holding on to hope. And the last sentence there is doubling down to me is easier than exiting and accepting a loss because I'm stubborn and I want to say, no, I'm right. Um, this stock is going to moon, but in reality, it may not. It might, but it might a year from now when all of your contracts have expired, worthless. So, I think it takes a bigger person to admit when you're wrong. So being persistent is not about being persistent that this position is correct, but rather that my account and my strategy um, will be successful one way or another. Okay. Paranoia is a mental disorder characterized by systematic delusion. Now, that's definitely strong, not necessarily what I mean, but quick shout out to mental health. A couple years ago, I started feeling abnormal, and so I went on some anxiety medication, and it totally cleared my thought process. I was able to be productive. But there's a period there where my mind was so scattered that I could not be productive. And so, yeah, quick shout out to mental health. If you're struggling with issues, then you should highly consider medication. It's changed my life. And then during 2020, um, homeschooling the kids and everything going on, I had to increase my medication. Hopefully I'll be able to decrease once things retain, get back to some normalcy. But so I don't actually mean paranoia. But what I do mean is just concern for things, to not be careless. People start off with $500,000 accounts, and because they have that money, they'll throw it all around. And a lot of people don't have that money. I didn't start off with that kind of money. Um, and maybe I would have wasted it all as well. But if you do have that, take the opportunity, that blessing that you've had, and use it wisely. And if you don't have that opportunity, then it's even more crucial that you be concerned with how well you use your money and how well you make your money work for you. So first bullet point is, obviously, I don't mean this at extreme levels. I just mean that you should be cautious. Consider what could go wrong with your trade, what could go right. Analyze both sides. What is the other side of your thesis if you're a bull, like I typically am? Think about what the bears are thinking. Is there validity there, or is it just paranoia on their part? That is a lot of the time what it is, conspiracy theory and paranoia that this stock is going to go to zero. Typically, on both sides, up and down, it's going to be overblown. Some people are saying uh, this stock could go so high, and the reality is it's not. That's why when I typically recommend trades, I like a defined range. I like to know what the top of where that stock could go, instead of just going up into nowhere. Um, it could keep going, or it could stop today. So I prefer a known upside, so that way I can sort of gauge the upside and downside potential. Hedge your bets if needed. So historically, I did a lot of that with some VIX calls. More recently, I've just been increasing the amount of long stock that I own, just to make it so that if there was a huge market move, I would at least have something tangible instead of option contracts that are all worthless. Um, so hedging could be from um, doing, getting some TLT or some metals or some VIX um, or the opposite side of your trade, or taking an undefined risk and making it defined risk. So there's a lot of different things you can do there with hedging. Um, Put down in the comments if you have a specific hedge strategy that you like to use. I would like to do a video or series of video on different hedging strategies, um, but I haven't quite nailed down exactly what I want to talk about there. So back to the paranoia, managing your position size. People again throw caution to the wind, and they'll bet huge sizes on one play, and it's like, well, what if that you put all your money into one ticker? What if that ticker doesn't do what you think it's going to do? Now you've completely blown up your account. So please at least just do small sizes or spread across tickers, and I talk about that in 2 bullet points here. But your position size, ideally, I'd say 5% of your account. Most people starting out would be watching these videos, and so realistically it's going to be 10, maybe 15, but definitely don't go over 15, and definitely keep some in reserve, which is my next bullet point. You need to manage the amount of capital deployed versus capital in reserves. So the reserves is so important when you're starting out, because you need to be able to take advantage of the opportunities at the best time in order to get off that initial little hurdle. The small account challenge now is around eight grand, so I can be a little bit worse on my entries and just put the position out there, and I'll make money. But it gets increasingly harder to blow up your account if you're relatively conservative. But if you deploy all of your capital at first, all for the same expiration, etc., and have nothing on reserves, a lot of those entries could be bad. An event could happen, like we talked about earlier, and now you've blown up your account. So I definitely like to keep a decent amount of reserves. For me, that typically looks like 1 to 5K, depending on the account size. Obviously, the larger the account, the larger my reserve would be. But then I also use the long stock as a place to park my cash. So second to last bullet point here is to balance over industries, strategies, the market in general. So if you can beta weight against SPY, that's great. To have positions that are long the market as well as short the market. But it's not always possible. Sometimes only one sector is moving, so you're going to be heavy in a specific sector. During the COVID recovery, obviously, I was in a lot of tech, and that was it, because that was the only thing that was moving. But generally speaking, where possible, spread, be as diverse as you can. Diversity does sort of go out the window when the entire market's crashing, but still, obviously, that's everybody would recommend that. Who wouldn't? Last bullet point here is just to circle back to paranoia. It should not be debilitating, should not be delusional. It shouldn't make you stuck. It should just make you think. And you need to be situationally aware as much as possible. What is going on with the market? So, when I first got started, I wondered what people's morning routines were. And so that might be a relevant point to talk here. It's not so much about being aware of every single thing that happens in the news, but the more you do it, the more you hear this is going on, and you can sort of parse out what's going to be important, what's not. But you have to simultaneously be aware and not inundated with news. I try to find the middle ground. just by reading actual news, less opinion pieces. So I don't do um, like Seeking Alpha. I don't really read their kind of posts, but I will occasionally do some CNBC or some other news where it's something that has happened as opposed to something that we think is going to happen. Anyway, I'm trying to limit my inputs to a degree, but I also want to be aware. So it is definitely a fine line. Let's get on to number 4. Number 4, obsess. Um, again, this is typically speaking, being obsessive is seen socially, I think, as a bad thing. I would say I'm pretty obsessive. Um, the first time I started to write a program was for my senior project in high school, and I didn't sleep for about 2.5 days. So once I sort of got stuck into uh, that mindset, I didn't want to come out of it. And even though I had no idea, now if I wanted to rewrite that program that I wrote then, it probably would take me half an hour. Um, but being obsessed in my head is just an intense focus on something. And although I've said before here that you shouldn't read everything you can uh, on the stock market and then get burnt out, I definitely would recommend reading everything you can up to the point of getting burnout. So reading and studying and watching and doing that consistently month after month after month, and then actually charting yourself and actually trying to predict where things will go and get comfortable with the indicators that you like, etc. Being obsessive with those, I think, is a great way to put your plan into practice. So definition here is the domination of one's thoughts by a persistent idea. And that idea for me, again, is macro level, growing my account by any means necessary. So so maybe that turns out in a couple years to not even be options if I find that I end up liking futures better or crypto or something like that. But um, yeah, the point is that you have to constantly be on that journey and thinking about what your next move is. So first bullet point here is creating a process that is actually the act of continually refining your process, evolving it, and finding other profitable strategies. So there's no easy ticket. You're not going to find one strategy that's successful and you can just deploy that over and over and over again. You also can't rely on some guru to tell you what to do because that person isn't going to be around forever. And what happens when they're not? I know a lot of people that got into Bitcoin at the beginning, and that's great. But can you reproduce that? Can you find something else? Maybe the answer is yes. I personally like to have as many tools in my tool belt as I can, and so I want to find as many strategies that I can to work in different environments, and deploy those as needed. So I generally have my core strategy, but then I have other strategies that I see a specific setup and, oh, okay, here I'm going to do that. Here I'm going to do this, which is a slight tweak. And some of that, it's even a little hard to put into words when you get enough experience that your mind just jumps right to certain things. And that's especially true if you document, which is the last bullet point here. But documenting and contemplating will help burn the successful styles that you've done into your brain, instead of sometimes you can harp on your losers, or you forget the exact criteria of the setup of a winner. So yeah, documentation is a huge part for me. Okay, next bullet point here is you should be obsessive about pruning your watch list down for efficiency. So, if every day you're checking 200 stocks, that doesn't seem feasible. And maybe your style use a scanner, and that's fine as well, but the time is going to be much more intensive there to find ones that you can like if your list continually grows. So in fact, I'm saying you should shrink your list if possible, if your style lends itself to that for efficiency, and then being selective on in add-ons. Obviously, you're going to add tickers as they become relevant, but not just adding them again because it's the hot new stock, but because you believe in that company or their mission or their potential for growth. I've talked about this before, understanding which stock lends himself to which style of play. So, I'm going to enter in an IPO substantially different than I'm going to enter in a long, slow trend up. I'm not going to enter in a long, slow trend down. A low float, I'm going to be more aggressive getting in and then scale into that. IPOs, back to the IPOs, I'm not going to get into the initial pop at all. And if it never retraces, then oh well, I just missed it. But so I'll wait 6 or 8 months before I even touch an IPO. But a lot of times IPOs will pop in the first week, and then they'll come back and revisit their initial value they IPO'd at, and then many times lower, and then that's when I start scaling in. So it's a very consistent pattern, but it's different than how I would play my typical options, as I would be doing long stock there because options aren't available on an IPO. And then I play those differently than high dollar volatile tickers. For me personally, that's like Roku. Roku tends to always burn me, but each one of those has a different way that I play them. So you need to understand the difference and document. And the next bullet point here is just continuation there. Understand when is a hit and run, when is a long-term hold, when is a double down. Each one of these things, I remember Neo when it first, I don't know, got popular. A lot of people were talking about the possibility of it being the next Tesla, and it's been a while now, and it's still nowhere close. Maybe it will someday, but yeah. So for me, that's a hit and run. Same with pot stocks, etc. Last point here is to learn as much as you can, practice it in the real world. I'm not a huge paper trader. If you can learn from that, definitely go ahead and give it a whirl. There's nothing to lose, so why not? But when you're having your real dollars in the real market conditions without the comfort of knowing that it doesn't actually matter, you might behave differently. The indicators you get might be different than be using some of the software to mimic the past, etc. So yeah, definitely real world makes a huge difference. And then starting off small, even if you have 500,000, I've said this before, start off with 5 grand. And if you can't make it work with that much, you're not going to be able to make it work with 500. But instead of losing 500 now, you've only lost 5. Once you can do that profitably for 5 months, if you have that, if you're determined to make that work and you are successful and you have the enough ability to say, oh no, I'm not going to touch the rest of it until I've proven this. For again, 5 months would be super minimal, but ideally longer. But realistically, I know I probably couldn't sit on that much money without trying more. But anyway, the longer you can do the smaller amount of money, the better. And then to document everything. That's why my site exists, and it's free to use. Why I created it for myself. I want to put as much data in as I can, and over time build as many reports as I can to visualize what I'm doing correctly, what I'm doing incorrectly, and morph over time to really be as efficient as I can. And then contemplate on those reports and say, what did I do right? What did I do wrong? And then again, enjoy the things that you've accomplished. So the last bullet point here for me is kind of the same as persistence. So patience is the ability to endure difficult circumstances. I think patience for me is probably the hardest to learn. When I first got started, I want to put on as much as I can, as many positions, and then I went through a phase where I was taking stuff off at 10% profitability, thinking that I could get in and get out as quick as I could. And we all like that action. It just feels cool. But ultimately, I think, the more you're trading and messing with things, the worse things get. It's better to just put it out there, let it do its thing, and then walk away from it. So you have to give it time to work. And then waiting for the entry point, the conditions under which you thrive to occur, instead of forcing trades, is very hard. So that's why alerts exist. They're built into most platforms. Just the other week I showed it in Thinkorswim, but Tastyworks and everything else every good platform has alerts. And they're there for a reason, so that you can focus on what you do and looking for potentially good opportunities, but using the alerts to really help you. Another thing that I think of when I think of patience is that many times my account stays like almost flat for a month, and then it'll have a huge jump, and then it's flat, and then it's jump. And then, I think about people that get bored. I even get bored during those flat periods, but that's when you need to watch out. That's when you make mistakes. You pull positions out that are actually very close to being profitable, and instead put them into something else that new position will have its own waiting time. And so you've just prolonged the amount of period that you're going to have to wait for something to be profitable. Or you'll just enter in a position that just totally doesn't make sense, just because you were bored, you got antsy, and you wanted to throw the money into something else. So yeah, be patience, and that applies to rolling. It applies to so many different areas. If you cannot tell yourself that I'll just come back to that later, and preoccupy yourself with something else, I think you're actually setting yourself up for failure. You need to be able to watch paint dry, especially if you're doing theta type of plays, in order to be successful. So, in general, holding the positions for longer can produce bigger returns, but it's obviously a fine line. So you want to be as efficient as you can. That's important. So you might try to close a position that had a huge it went your direction, so you were bullish. It had a huge jump up, and so now if you had a short put spread, you could close that out for a quick 25% and then redeploy it. But my issue and concern there is that the new position that you put on could be a loser. But the flip side of that is you could hold on to a good position that would turn a winner into a loser. So, and then another caveat is the further out of the money. So you sold the put spread and the stock had a huge jump. Now it's further out of the money. The Greeks are going to act slower now, and so your position is going to decrease in value, which is what we want if we're short a put spread slower. So it is definitely a fine line, but more times than not, being patient and letting it work out on its own is beneficial than trying to jump the gun. And that goes back to entering again, where I definitely have issues where I'll enter in a position too soon, and if I just wait even a day or two, then I can get a better entry. That's why a lot of the people that follow my trades end up being able to close their trades before I can close mine, because they got better entries than I did. So that's really all I have today. Those are the 5 traits. And hopefully, if you hopefully you find some of these valuable. But the most important point is that you're thinking about stuff, and then you're thinking about what emotions or aspects of your life that you can work on the best to make you the best. And yeah, so hopefully mine gave you some ideas, and you can think about yourself and make 2021 a better year than 2020. That's all I have, and I'll talk to you next time. Thanks.